Welcome to the training course on financing for disaster and climate resilience. This course begins with an e-learning session that helps you prepare for the in-person training. This e-learning module is on overview of disaster risk finance and insurance. This e-learning module will help you to understand what risk financing is in the context of disaster and climate resilience and understand risk financing in practice through its various instruments, practices, examples, and challenges. In the next 40 minutes of this module, we will cover fundamentals of risk financing through 5 key questions, risk financing instruments that are used for risk transfer and retention, key factors for finding the right risk financing solution, and finally, the challenges that hinder the uptake of risk financing solutions. Let us begin our e-learning journey with the fundamental questions. The first question that we need to understand and have clarity on is the difference between climate change adaptation and disaster risk reduction. We typically use these terms interchangeably in the context of risk financing, but the difference is important to understand the context of risk financing and designing the right instruments. Disaster risk reduction includes the reduction of risks from geophysical disasters such as earthquakes, tsunamis, landslides, and volcanic eruptions. These are not influenced by the changing climate. As a result, risk modeling for these disasters relies on historical data. You may have commonly heard terms like one in a 100-year disaster event. This means that over a period of 1000 years, you would expect the one in 100-year event would be equaled or exceeded 10 times, or that there is a 1% chance of an event of at least that size in any given year. Climate change, on the other hand, includes very slow onset events such as sea level rise and desertification, for which adaptation action is needed even if they are not manifested as immediate disasters. For resilience and climate induced impacts, one has to also factor in any positive changes that climate change may bring about in a region. That is usually not the case for disasters, which are by default damaging in nature. Risk assessments in climate change are not probabilistic like that in disasters. Climate projections are based on future scenarios and pathways. The pace of climate change is also very fast. Therefore, historical data is not a good reflection of how climate will impact our systems in future. Finally, disasters have been known to humankind for a very long time, but anthropogenic climate change, which is caused by human activities, is a relatively recent phenomenon. The important point for building resilience is where these two converge. Hazards like storms, cyclones, floods, droughts, and temperature extremes are disasters, and their frequencies and intensities are increasing due to the changing climate. They have socioeconomic impacts where the hazards pose risks of deaths, injury, loss of resources, and damage to infrastructure. Risks from climate change and disasters are compounding, converging, and intensifying. To give you an example, recently, two destructive Category 4 tropical cyclones, Judy and Kevin, and an earthquake with a magnitude of 6.6 impacted over 80% of the population of Vanuatu in March 2023. All this happened in a span of 48 hours. Therefore, there is a need for an inclusive approach, an approach that is all of state and all of society and leaves no one behind to manage the compounding, converging, and intensifying risks from climate change and disasters. This need for inclusive approach is also true for building resilience through risk financing. Okay, let's move on to some hard numbers to understand what the current landscape of disaster looks like. What is the impact? Most recent data from EMDAT, the International Disaster Database, shows that the Asia Pacific region disasters affected 64 million people and caused economic losses to the tune of 57 billion US dollars. This is just in 2022. If you look at the cumulative data of economic damage from disasters in the Asia Pacific region and the rest of the world in the last 50 years, then we are talking in the range of 2 to 3 trillion US dollars for Asia and the Pacific and another 3 to 4 trillion US dollars for the rest of the world. Hydrological disasters like floods, droughts, and storms garner a lion's share of damages in the world. In the Asia region, earthquakes also contributed to significant losses. There is also a noteworthy trend that we need to keep in mind. The trend in the decadal average of fatalities and number of people affected has gone down in the last 50 years. And this is a result of active disaster risk management initiatives being taken across the globe. However, the economic damage resulting from disasters is still on the rise. And this is a big indicator that we are lagging in protection against disruptions in the systems, damages to assets, and providing financial and social protection to the most vulnerable. Therefore, we need to work, among other things, also on our risk financing strategies and mechanisms to make finance available to cover up for disaster induced disruptions and provide for post disaster recovery and reconstruction. Moving on. What are the reasons why we need risk financing for managing climate and disaster induced risks? First and foremost, any comprehensive risk management plan would have risk financing as an integral component. On the right side, you can see different stages of a comprehensive climate and disaster risk management plan, which includes a critical stage of risk financing. Without disaster risk financing, every stage of disaster risk management may falter. Therefore, faster reconstruction will not be possible. Disaster response will become too expensive, and early response will not happen. Essentially, there will be a shortfall at every stage of risk management, making it more expensive to deal with the activities of the different stages. There are two broad categories of risk financing: ex ante financing and ex post financing. And this brings us to the next fundamental question, which is what exactly is risk financing? The textbook definition is that risk financing is the deployment of financial tools and processes to mitigate the impact of events which have a negative effect on the financial flows required to support a system or enterprise. In layman's terms, if I have to contextualize, then any financing mechanism or tool which, when deployed, helps bring down the overall cost of activities in the disaster risk reduction cycle or reduce the risk of exposure to hazard constitutes risk financing. When this risk financing is arranged in advance of occurrence of any hazard or realization of disaster risk, it is called ex ante risk financing. When risk financing is arranged after the hazard, then it is called ex post financing, where the greatest focus can range from supporting immediate to intermediate relief, recovery of the affected people and systems, and reconstruction. Some examples of ex ante risk financing include investments in risk assessments, institutional capacity building, and emergency preparedness that help build long term resilience. Loss modeling frameworks for assessing risks are data intensive, and it can be expensive to build these assessment frameworks, but these are important for designing the right interventions. Risk reducing and mitigating infrastructure expenditures such as seawalls, building storm drains, reforestation, etc. Costs associated with development of regulatory standards to promote climate resilience. For example, if you have building standards, it would protect the buildings against earthquakes, or urban nature-based solutions can minimize the impact of heat waves and floods. Investments in early warning systems, social protection, etc. help reduce vulnerability. And costs for development of legal and regulatory frameworks to increase the availability of risk insurance, such as regulations for payouts, policies for supporting the engagement of the private sector, grievance redressal mechanisms, and so on. All these are examples of ex ante financing. Ex post financing, as I mentioned, focuses on relief, recovery, and rehabilitation. So, examples of ex post financing are whatever goes into emergency response and assistance, such as food, clothing, medicine, evacuation, etc. Economic recovery to support the state owned enterprises. Quite often, after intensive flood damage and disruptions, governments have to intervene to support the economic recovery of small and medium enterprises by giving incentives. Infrastructure reconstruction and the reconstruction of uninsured housing, any associated logistical and supply chain costs, which are particularly high for remote areas, and in case of earthquakes and also landslides, these can run for a long time. Loan repayments or concessional financing for financing the measures that I listed above, which can be extended to provincial and local governments, NGOs, or even the private sector. Moving on, let me give you some numbers to understand the effectiveness of risk financing. The first point to note is that while ex post financing is necessary for rebuilding and leaving no one behind, especially for risks that got realized and weren't factored in, it is the ex ante risk financing which is considered both more efficient and effective. This means that if you have to invest in risk financing before the hazard happens, then the results are better. On the right side is a stylized figure taken from a World Bank publication where you can see that the resource requirements are huge in the reconstruction phase. And if one wisely invests in ex ante financing, then these resource requirements can be brought down significantly. While we want the focus of risk financing to be on ex ante financing, disaster related financing continues to be unbalanced, with most being contributed from humanitarian budgets for responses delivered by partners immediately after a disaster event. There is enough evidence to show that effectiveness of ex ante risk financing. The World Meteorological Organization, in its early warning for all initiative, estimates that 800 million US dollars investments in early warning systems in developing countries would prevent losses to the tune of 6 to 13 billion US dollars annually. This means that through greater planning and preemptive investments, protecting significant development gains and not letting them wash away in a disaster. Independent estimates from the Global Center on Adaptation and the World Resources Institute show that investments in resilience building and adaptation can lead to benefits which are 2 to 10 times more than the investment. Another World Bank estimate shows that building resilience into infrastructure systems is only 3% of the overall infrastructure investment needs. And if you try to simplify it, for every dollar invested in the resilience of infrastructure, there are benefits of $4. With this, we conclude the fundamental questions on risk financing. Let us now move on to the practical aspects. What are the instruments of risk financing? In this table, you can see various important instruments classified based on the source of funding and the timing of investment. The first column has national and international sources. The next two columns show ex ante and ex post instruments. The last column has instruments for resilience building, which one can consider as long term and project centric investments for resilience building. The top two rows show instruments where risk is retained. The last row has the risk transfer instruments. These instruments are very basic vanilla instruments that are commonly known, and by no means is this table meant to be an exhaustive compilation of instruments. So, what are these terms? Let's start with risk transfer. Risk transfer is the process of formally or informally shifting the financial consequences of risks from one party to another. Insurance, for example, is an important risk transfer instrument where coverage of risk is obtained from an insurer in exchange for ongoing premiums paid to the insurer to cope with losses after major disasters. Risk transfer usually works on risk pooling. Under this system, groups of private or public actors, insurance companies, or countries come together to form a pool of resources which can provide protection against catastrophic risks such as floods or earthquakes. A simple arrangement would be an individual policyholder paying a premium. The company pools these resources and pays out to policyholders who experience the hazard or where the risk is realized. Insurance is an ex ante measure, but there can be regulations in place where liabilities can be set by regulations after the disaster. In this exceptional case, insurance can become an ex post measure. What is risk retention? Risk retention approach involves retaining responsibility for the disaster risk through a planned acceptance of losses should the hazard realize. Typically, this involves sovereign disaster risk financing through national budget. One sees this in high frequency and low severity events. Government may use dedicated funds, domestic catastrophe reserves, loans, and other off-budget instruments that are at their disposal to increase their financial capacity in the immediate aftermath of a disaster while still protecting long-term fiscal sustainability. Residual risk is the amount of risk that remains in unmanaged form. That is the level of risk that remains after all disaster risk management measures have been put in place. It is something that you cannot do much about. Finally, risk layering is separating risk into different tiers to allow more efficient financing and management of risks. High probability, low consequence events may be managed by savings or contingency funds. Low probability, higher consequence events may be transferred to the markets, or they may need aid, and one may want to plan for it in advance. Let's look at each of these instruments, starting with those that are sourced domestically. First, the risk reserves. They are created by the government before a disaster happens, providing resources for immediate relief and recovery in the case of recurrent low to medium severe disaster events. For example, FONDEN, Mexico's Fund for Natural Disasters, was established to support post disaster reconstruction efforts without unduly constraining the budgets of the governments. It has a strong focus on building back better. The fund employs a risk clearing approach to support the government of Mexico's disaster risk financing needs. This layering approach helps identify the best instruments and sources to fund different types of risk financing needs. Next, you have budget contingencies. These are set aside by the government before a disaster happens, serving as a budgetary reserve to compensate for losses of recurrent low to medium severe disaster events. Budget reallocation, tax increase, and domestic credits are ex post sources to mobilize additional resources in the recovery and reconstruction phase. Mobilizing finance from these sources usually requires additional legal steps and thus takes more time as compared with ex ante risk financing. These budgetary and taxation instruments are typically used only when the option of calamity funds and budget contingencies is not available or those funds have been exhausted. Next, let's talk about instruments with international sources. First is contingency credit. Contingency here has the dictionary meaning of emergency. In this instrument, a donor or bank pre-commits to provide credit on concessionary terms, usually to a government when a disaster threshold is triggered. For example, the World Bank Group provides contingent credit lines through its contingent financing programs, allowing borrowers to rapidly meet financial requirements in case of a medium or large scale disaster. Contingent credit lines are an ex ante instrument. Donor assistance is provided after a disaster by international donors for relief, recovery, and reconstruction. This can be through grants, concessional loans, guarantees, or equity capital. This is an important source of risk financing, particularly for highly vulnerable poor countries in the aftermath of medium or large scale disasters. However, these funds usually require months to be released, which is usually minimal. Next, we have external credits and bond issues. These resources mobilized on capital markets at market prices, that is, the most expensive form of climate disaster risk financing. These become particularly expensive for poor countries because they have low credit ratings. The external debt situation of many countries, like the small island developing states, may hinder their ability to access financial systems because most of their earnings may already be going into debt servicing. Let us now talk about instruments for risk transfer to third parties. We already talked a little bit about insurance. Insurance premiums to be paid by the policyholder reflect the risk. If this risk has a high probability of realization, the premium is also high. Risk insurance can be parametric. This means that a payout is made automatically if a predefined parameter is breached. For example, rainfall of 100 millimeter in 24 hours or a wind speed of 150 per hour is breached, then the payout is automatically released. Then there are insurance instruments which are indemnity based. This is a better fit as the payout reflects actual loss. However, indemnity based payouts are complex and costly. They take much longer for payout processing as detailed assessments for loss have to be done and it may include in person surveys. At a national or regional level, we have sovereign or regional risk pools, which in most cases are owned by the insured sovereign states themselves. Risk pooling happens across countries or even regions. Such large scale mechanisms are very effective in bringing down the costs and risks significantly sharing resources, which in this case are data and financial resources. The more heterogeneous the risks and risk exposures faced by the sovereign states or policyholders, the lower the risk profile. The sovereign risk pools are an effective mechanism to address losses from less frequent but severe disasters. The Caribbean Catastrophe Risk Insurance Facility and the Pacific Catastrophe Risk Assessment and Financing Initiative are some examples of regional risk pooling. Catastrophe bonds or CAT bonds are market based instruments. They are under an umbrella of instruments called risk linked securities that transfer an ex ante defined set of risks from hazards like cyclones, floods, or droughts to investors. CAT bonds are usually used for insurance securitization to create risk linked securities that transfer a specific set of risks from an insurer to investors. In this way, investors take on the risk for a specified catastrophe or event occurring in return for attractive rates of investments. Suppose the qualifying catastrophe occurs. The investors will lose the principal they invested, and the issuer, which are often insurance or reinsurance companies, but also states or governments, receive the money to cover their losses. Catastrophe bonds were first issued in 1990s after Hurricane Andrew. Moving on to the instruments for financing resilience building through climate risk management and adaptation. To finance climate adaptation and reduction, government usually create their own budget lines. For example, a Ministry of Disaster Management will have a dedicated line for specific resilience building activities. Some countries have also set up their own climate funds. In Bangladesh, for example, they have the Bangladesh Climate Change Trust Fund, and in Pakistan, they have the National Disaster Risk Management Fund. Many countries offer assistance through grants or concessional loans, technology transfer, and capacity development for building resilience in bilateral country to country arrangements. Like the Swedish government does it through SIDA, Denmark through Danida, and Germany through its International Climate Initiative, while working closely with receiving national governments. There are also multilateral climate funds like the Global Environment Facility, Green Climate Fund, and the Adaptation Fund, which finance resilience building projects. The risk financing instruments that we discussed are broad in nature. They need to be customized to suit the needs and context of a country. So, what are really the questions that need to be answered to find the right risk financing solution? First is on risk information. Can the chosen instrument help countries understand and price their risk? Does it incentivize investments in risk reduction and preparedness? Does the instrument support risk based pricing? Second is on the cost of capital. How effective is the instrument in assessing financial resources after the disaster event? This is both in absolute terms of affordability and in relative terms against other instruments. Third is on timeliness. Timing of finance availability can be a deal breaker in response and recovery processes. So it is important to assess if the instrument can make funding available at the right time. Fourth is on discipline, which is all about accountability and transparency in post disaster spending of funds. And finally, it is the ownership through which the instrument can define risk ownership. That is, there should be clarification if the entity paying for the costs is also bearing the risk. The relevance and utility of risk financing instruments in managing climate and disaster risks within a comprehensive risk management framework is uncontested. Yet, these have not penetrated to commensurate their potential in risk management. This is largely due to lack of adequate risk financing data to develop robust financial protection strategy. This includes both historical and data and climate projections, as well as micro level data on consumption, socioeconomic data, and so on. Risk models for designing insurance can be very expensive. The institutional coordination and their capacities among different ministries, divisions, and sectors to pursue risk assessments and to implement a risk financing strategy are inadequate. The definition, scope, and utility of disaster risk finance may not be robust. Monitoring, reporting, and verification measures are typically weak and inconsistent. Private sector engagement in risk finance may be misguided, or there may not be sufficient initiatives in that domain. And finally, the instruments need innovation and customization to suit specific contexts, and there may not be either enough technical capacity or initiatives for innovation. And with this slide, we conclude the e learning module on overview of disaster risk finance and insurance.